Ladies and gentlemen, it's a pleasure and honor for me to welcome all of you to our online seminar. I'm Sergey Levin. I'm founder and CEO of Cbonds, and we continue our activity in making such online events devoted to current economic situation, investment ideas, etc. The situation in the world is still very, very controversial. We have very high numbers of new COVID infection every day, and these numbers are now at almost 200,000 people per day. We have worse and worse estimation for GDP growth in both emerging market economies and developed markets, and every time when these estimations are updated, they are worse than they used to be. We still have some contradiction between US and China. We have some protest activity in US, etc., 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 and all that should theoretically mean that the stock market should go down, etc. But we see the opposite, and many asset classes are on the historically highs. Like, for example, Nasdaq is on historically highest levels. We also see that bond yields in many areas are on the historically lows, like in US dollar, it's less than 1% for US treasuries already, and some analysts are speaking about the possibility of US government bonds going to negative yield area, like in some European countries, like in Japan. So something that was absolutely unpredictable even half a year ago, but not only in US, in some other countries, like for example in Russia, bond yields are also on the historically low level. So the situation in the world is really very, very controversial and very, very unpredictable, and which means that investors should be very careful in taking their investment decision. Because wrong decision now can have bad consequences for investors. And these are the topics that we are going to discuss today. And this seminar we are arranging together with a company called Blackfort Capital, which is a Swiss-based wealth management company, very fast growing now. And our key speaker will be Andreas Bickel, who is Chief Investment Officer of Blackfort Capital. Andreas has a profound experience with more than almost 25 years in such reputable institutions like Goldman Sachs, Rothschild, and Deutsche Asset Management. Andreas has PhD in finance from Zurich University and MBA degree from Zurich University as well. So now we will hear about his view on today's situation, on economic situation, and situation with asset class in the world. Andreas, the floor is yours.
From my side, thank you, Sergey, for the introduction. As you can see, I sit quite close to where this picture is taken from, and the weather is very similar. So we are a Zurich-based asset manager with a focus on emerging market, corporate bonds, high-yielding bonds, and most of our clients come from the CIS region.
Andreas, I'm sorry for interrupting. Please switch on your camera.
Sorry. So far, so Swiss-based asset manager concentrating on corporate bonds, and we have already heard that the forecast for most institutional like the IMF, the OECD, they are getting worse and worse, but stock markets go up and yields go down, and bonds, in particular corporate bonds, perform very well. The key question is this a surprise? And our answer would be no so far. However, the question is always what comes next. but let us go step by step. What is worrisome at the moment is euphoria, but only within small areas of retail investor. There is fear of missing out, so we'll cover that part and what happened on the professional side. We have definitely to cover the topic of W recovery, which basically means a double dip recession or a V-shaped recovery or something in between. I believe that we are in a financial repression situation, and therefore I will explain what that means, but the key point or takeaway will be how can you protect your wealth. There is as well trend which is positive if you invest in emerging market. The dollar is on average starting to weaken, and all these topics I'm trying to cover in the next 60 minutes roughly. So let me start with this. We have seen a tremendous rally, and since roughly 1 month a consolidation, actually since Mr. Powell has spoken on his press conference and said that the interest rates from the Fed side will stay at 0 at least till the end of 2022 and even in 2023. So 3 years, more than 3 years from now, the likelihood that we will see sharp rising rates is very limited. This has also caught hedge fund managers who were so far poorly performing, trying to bet on the downside. But on Friday, as you probably know, we have seen a sell-off due to fear of second wave of corona. However, yesterday these positions were mostly unwinded and we have seen a rebound. You see it also here. The last 3 months, so the quarter, was tremendously good. So after the sell-off due to corona and then the COVID illness, we have seen at least in March and in May a tremendous rally, while in June the return on S&P is roughly 1% and in US high yield it's roughly 2%. Investment grade and treasuries were roughly at 0%. So the rally was basically after the sharp sell-off, after all these negative announcements, after the foreseeing of a deep recession in Q2, where we are most likely in during that period, we have seen a tremendous outperformance of risky assets, in particular corporate bonds in the lower end sector, fallen angels, and equities. This was missed by most professionals. One of the key reasons you see here, this is the aggregated balance sheet of the 4 biggest central banks in the world, and with it it's shown the development of MSCI World. And as you can see, there was the corona shock, and immediately there was globally cut-off rates and stimulus program, QE, etc., etc. And with it, the stock market went up sharply. Interesting enough, although we have seen this rally, you see here this kind of indicator. It is from Bank of America. As long as we are in the green area, and you can see the latest figure from Friday is 1.9, so green. The figure from 2 weeks ago is roughly 1.5. So we were the whole time being in an area where institutional investors, this is measured by certain ingredients like money flows, like positioning, like outlook, etc., stayed in the extreme bearish sentiment, and the market rallied. That means 2 things. First, most professionals have basically missed it. Second, the little people who were invested differently like the professionals, and you will see that in a second. So from that angle, forward looking, if you just look at this indicator, and in the past this used to be a very good indicator for asset allocation, you should definitely not under allocate to risky assets. If it's time really to add more, we will cover during the next slides. However, the rally was definitely missed by most institutionals. The Fed chair has, for my humble reading, said we will keep rates at 0 for very, very long time. And at the same time, there was a kind of announcement that there will be a modest inflation pressure and there will be more bond buying. This is or are all ingredients which basically describe a situation called financial repression. We can argue about the term, and I will explain in a minute what the term really means, but the key ingredients are low rates, bond purchasing program, and that for a very, very long time. These are definitely ingredients for risky assets to continue to go up and probably also to buy real assets. We have seen a rally, but here you see the chart roughly since 1.5 years falling. That's the performance. When it goes up, the hedge fund guys outperform the retail guys, and when it goes down, it's the opposite. And as you can see, in the last bit, it was basically vertical falling. That means over the last 3 months, retail investors have substantially outperformed the professionals. The professionals were underallocated. Most of them sold off in March after the markets went down and never re-entered the market, different to retail investors. What did they buy? On the right-hand side, you see American companies. Most of them are fallen angels, so they were investment grade. They lost the investment grade rating. The share dropped dramatically, and then the retail guys bought it. You see on the left-hand side, the investment guys buy traditional, strong companies, growth companies, even Visa, which should profit from the actual situation as everybody buys online, or MasterCard. They were, compared to these fallen angels, underperforming. Alphabet, the mother company of Google, had a good run, but compare on average to retail investors, they were underperforming. The reason is why. The answer is, if you got unemployed, and more than 20 million people got unemployed in the United States, you got every week $600 a paycheck. This is more than most people normally earn. On top of it, every adult got $1,200. I call it helicopter money, or you can call it immediately help money from the tax authority. So if you are a family, 2 adults gives already $2,400. 2 children, each children 500, you are already at 3,400, plus every week $600 for being unemployed. Suddenly these people were, for a short time period, very wealthy. And Americans, when they have money, they either consume or this time they started to speculate. You see this here? These are open position in calls, all initiated by small traders, so over electronic platforms, some are over Robinhood, some are of the traditional ones, E-Trades and Charles Schwab. But you see, it is on a 20-year high. So there was tremendous money flowing in. And some people compare this to going to the casino, which was closed, or to go to the stock market. And it seems some means 13 million, 13 million people is unbelievable, open new accounts in the last 3 months. You see this also here. On one hand, the light blue is basically the positioning of traditional investors through futures positions, measured in billions, but disregarding the scale, you see that they are under allocated to risky asset, while the Robinhooders, that's the dark blue line, this is measured only in millions, not in billions. You see that they start to allocate strongly to risky assets. This is an indicator that there is a huge divergence, and at least up to now, the move from the retail guys was profitable, while institutional investors are suffering. You see it here. What do they buy besides what I've said? This company is called Nikola. They produce lorries, which will be using instead of petrol, hydrogen. It is extremely innovative. However, there's not even a prototype. Nothing really ever was on the road. No lorry was produced. And you see, based on trades of the retail investor, the company rose more than 8 times and has a market cap of more than 30 billion, although there is so far only a concept, which I would say is interesting and might be the future, but there is no revenue behind it. This reminds me slightly to what has happened in the dot-com bubble, where everything which was .com went up like hell. This kind of investments, however, are so far, because there is no correction, we are still above 60, very profitable for all these guys who bought it. You see also, size does not matter, or to turn it around. We always hear of the Robin Hooders, and you see Robin Hood, this is this red line. There is almost nobody compared to the others, e-traders in Robin Hood. Even so, most analysts come to the conclusion that the movement in stocks was done by trades initiated on that platform, and to a lesser extent to the two others shown here. We also saw that there was a kind of repositioning from risky assets out to less risky assets on the slide before. You see this here, money market funds, that's the blue dark line on the top, has risen dramatically, so they missed all the bandwagon. There was a comment, on the other hand, that we see now flows from money market into equities. At least based on this US statistic, I would argue that the inflow in the light blue line, which is equity, is rather limited, almost to be neglected. However, in corporate bonds, there was a certain inflow, and the best performing corporate bonds were the fallen angels like the Fords and the Delta Airlines of this world, who were once investment grade and are now junk. But this junk can, on one hand, be bought directly by the Fed, and on the other hand, a lot of retail investors jumped on these names, and the Fed, with the announcement, ensured that they were able to issue new bonds. And these bonds, most of them, they came out obviously at 100, but they trade now between 105 and 115. So for yields which are definitely too low given the rating, but they have a kind of put, and the Fed supports them. So we have seen, there is a rally, it's still ongoing, but the question obviously is what comes next. This is a survey done every month by Bank of America Merrill Lynch. It's the fund manager survey. They asked the fund manager how they are positioned and how they see the near future, and if there is a recession or if there is a V-shaped recovery. And the answer were astonishing. On one hand, they talk of a W-shaped recovery. W-shaped recovery is nothing else than a double dip recession. So we are in the first dip and there will be a second dip, almost 50%. Some of them think maybe it's U-shape. Very few think it's V-shape or L-shape. So a majority expects a very sluggish recovery. In the same survey, they also ask, how are you positioned? And the answer was, well, we have reduced cash, not because we believe that there will be a positive outlook, that there will be a recovery. No, because they were underperforming retail investor and they want to reduce versus their benchmark, their risk. So there was a shift slightly to more equity, to more risk, although the belief in this positioning is extremely limited. So therefore, we could conclude, at least from that angle, there is no euphoria from institutional investors, although they have slightly increased their allocation to risky assets. This is one of the several announcements we have seen over the last couple of weeks. Basically, this is the Oecd forecast. The red line shows a double dip hit scenario based on Corona. And the blue one shows a scenario based on just one wave of Corona. Needless to say, in both cases, the OECD, not shown here, the IMF, and a lot of other professional forecasters, they expect that we see a deep recession. This is a no-brainer, but the recovery will be very sluggish, and most likely we only will see in 2022 levels of GDP like we have seen before the corona crisis. This scenario obviously doesn't fit to what has happened in stock markets and in bonds, because as you know, they have performed well, so they discount basically the future, and at least these two markets see it completely different to what these forecasters tell you. We also, to say that for the first time, we are, depending on the region, in the camp of U to V shape. Definitely we would argue that next year there will be growth. Mr. Powell said at his press conference that this year we will shrink more than 6%, but next year we are going to grow roughly 5%. The second part of his statement, that next year there will be a growth of 5%, was completely neglected. By the contrary, the market concentrated on the low rates for longer and on the sluggish growth, and we have seen at that day a sell-off, and since then a consolidation. But I would agree that this plus 5% of the Fed are most likely achievable. Maybe they are slightly too negative. I prefer to look at indicators like this one. This basically shows you the difference in yield of the 10-year and the 3-month, and of the 10-year and the 2-year government bond in America. As long as this curve is going up, we can say that the curve is steepening, or the future of the bonds and the economy is brighter, slash the bond market expect that there will be growth and higher yields down the road. That's why the curve is steepening. Another way to argue about it, and I have read that several times, the curve is now steepening. We are going to be in a recession. Well, actually, the chart even shows you we are in a recession. The red shaded area indicates that there is a recession. The key question is, how long will that last? My guess is, given this sharp rise and other things I will show you in a minute, is that there will be growth next year, and therefore I would definitely argue that the bond market and the equity market are discounting a better future and not a double dip recession. The only real positive case during the whole period was Morgan Stanley, that you see on the left-hand side. They have revised their already positive view recently. They now expect that in Q4 next year, GDP will be higher than before. And this is GDP of G10, not just of the US. If you look on the right-hand side, you see that on average, a recovery in a recession takes 18 months or much longer. And this would be an extremely fast recovery. They call it a deep V-shaped recession followed by an extremely strong recovery. But these were the only ones who were the whole time having a positive outlook. Goldman Sachs, as an example, said, for example, that we will see a sluggish growth this year, a recession in Q2, and next year sluggish growth. In the meantime, they have revised, and they are almost as positive as Morgan Stanley, which you see here on the left-hand side. So it all boils down what will be the future. And normally at this time, I would show you indicators like PMIs, like economic surprises, like consumer confidence, etc., etc. But as we have seen a lockdown, these indicators don't work at the moment, because when you are locked down, you cannot really consume. If you're a purchasing manager and most of your production is not sellable, or even the production is stopped in some areas, and you were asked a survey how you see the future. Well, first, you are special if you answer in such a situation, and second, most likely your answer is distorted to the recent events. So there are high frequency data which are a proxy to see how the development is in the economy, and then to try to estimate what that might mean for GDP. The US consumer, as you have heard from me before, if you are unemployed, or if you just look at the cash you got from the government, you definitely have more money in your pocket. If you have a job, you have your salary plus the money, and if you have no job, you most likely have even more money, unemployed money, than you would have if you would work. And you see this here. There was a drop in consumer spending in various sectors to roughly 70%. In Europe, this figure would be rather 80% down, so you would see 20. And in the meantime, most sectors are back to 19, some even almost at the levels before, and some above 80. But from that angle, we can definitely argue the consumer until roughly the mid of June was almost back. This statistic is from yesterday, so it shows you even more recent data. This is the usage of a particular credit card and debit card from a particular bank. And you see that compared to the usage before, we are roughly at minus 10%. So it confirms basically that the American consumer didn't stop spending, or let's put it the other way around. We had a drop of roughly 40%, but in the meantime, most of it, three quarters, are back. However, this is also a statistic from yesterday. You see that in certain areas, that there is a certain slowdown, and therefore this is more pointing to a U than to a V-shaped recovery. The reason for that is basically because we have seen in some states second wave, I shouldn't say, a reacceleration of outbreaks of the coronavirus. And this is reflected here, but don't forget, also here, this is the same period, and the conclusion of the person who did that analysis was basically, although we have seen so many new cases and spreading of the virus, people keep spending on average. So I would say from this data, it is probably fair to argue we are somewhere in between V and U shape. China, there we have more data, and the crisis is probably over for longer. On the right-hand side, you see in red the usage of coal to produce electricity. We are already for quite a while at levels of the pre-crisis. On the other hand, you see on the left-hand side the consumer. The consumer is not yet there. It's roughly minus 20%. You see also the hit when they had to close in Beijing and Wuhan for a second time, a small area, that there is a hit, but the consumer is back at a reasonable level. So for China, we could argue it's more U-shaped than V-shaped. However, the lockdown was not so severe in terms of GDP impact than in the Western world. Europe is a different animal. Here you see the usage of toll roads in Italy, Spain, and France. These were the three hotspots, especially first Italy and then Spain. And you can see we are still minus 40 to minus 60%. So it's rather a U-shape. I must add that this figure is roughly 10 days old. I would expect the recent figure to be higher, although in Lisbon, as an example, they will start with a local lockdown on tomorrow. Although the statistic doesn't really show a problem, there are some regional hotspots, and in some regional area there is most likely going to be globally lockdowns. Having said that, regional doesn't mean there is a lockdown for a whole country, and on average, at least in the Western world and in Asia, figures are going down. Here you see the traditional indicators I would use. On the left-hand side, PMIs globally, most concentrated on Europe, but you have also rest of the world. I find it amazing when you read the comments. I mean, minus 10 not minus, but 10 is a level which means 90% of everybody says we are seeing a worse future. Now most of these indicators are back between 40 and 50. Some are even slightly above 50, and 50 basically is where it gets interesting, where people see growth ahead of us. Therefore, if you look at PMIs, and I'm very cautious with it at the moment because I think this data is distorted, but from the PMI data, we could argue it's V-shape. I would be cautious, but I would say U-shape is likely, not V-shape. On the left-hand side, the economic surprise indices from Citigroup. You see the red line, the US, the index is at such a high level that forward-looking, it is more than reasonable to expect certain worse data and maybe a consolidation in the market, which actually is happening at the moment. While on the other hand, you see, for instance, the Eurozone, we are still in the negative area and Japan is floating around. This indicator basically is a good contraindicator. So therefore, I would be, from an asset allocator point, a bit cautious at the moment, given where the United States is. You can be a bit more positive for the Eurozone, but investment-wise, we still prefer dollar assets and emerging market assets in hard currency and less Eurozone. But definitely this is a certain warning, so it also points rather U-shape than V-shape. This chart is more than 2 weeks old. Basically, it shows these orange dots that 2 weeks ago it could have been expected that based on bottom-up collected data, there will be an acceleration of new cases within the first wave, different to the national statistic. And guess what? These are the actual figures. So the white line on the top, you see that we have seen aggregated in the United States a tremendous rise in new cases. Texas, as an example, has another lockdown. It's a complete standstill. However, if you see the blue line, which shows basically China and some key areas in Europe on a still existing level, but closer to 1,000, 2,000 cases a day, we are stabilizing. Having said that, this includes the local hotspots, and also the reaction of the governments is at the moment, if there is a further lockdown, it will be only local and temporary, so 1 to 3 weeks on average. Therefore, also this points to the conclusion that we probably see a U-shaped recovery because there will be no standstill anymore. However, besides the US, we have LATAM. LATAM, especially in particular Brazil, but also other countries, is significantly going up. You see emerging Asia, Eurozone, Euro area, as it's written here. We are not at zero, but we are at extremely low levels. The key problem we have in Europe is that the R value, so the value basically which measures how many people get infected if somebody gets infected, is above 1. In Switzerland, you see Switzerland here, we are on the place 41st in the world. We had 62 cases over the weekend. And the problem with the 62, I know that actually, but the problem with the 62 is that the reproduction is above 1. So the virus doesn't get controlled, and it doesn't get lower the number of infected people overall. Interesting, you see Israel, they are even better, they're on place 50. They had 333 cases. However, the news in Israel is that the government thinks they are getting the control out of hand because the reproduction value is extremely high there. But if you look at the list on the top, the US, Brazil, Russia, India, you see that in all measures, be it new cases, be it deaths, be it death per 1 million inhabitants, or even how much people were tested. Both Switzerland and Israel are definitely showing quite good figures, but in both cases the news is quite negative that there might be a second wave. While in the US, on the top, you see there were 40,000 cases. The day before, there were between 35 and 40,000 cases every day. So it's really accelerating, similar to Brazil. Russia, on the other hand, had most of the time 9,000 to 10,000, and now for some days we are below 7,000, but it's still extremely accelerating. New on the list is India. India made it, unfortunately, to place 4 and is continuing to accelerate. For European Union, important is that, for instance, the first hotspot, which was Italy, has, in terms of new cases, a very contained number. There, I haven't seen any information regarding local lockdowns or problems, while in Germany, for instance, they had a scandal with a meat factory, and they have some areas which have a complete lockdown. But on average, also in Germany, it's going to accelerate the growth. Last but not least, Sweden. I mean, Swedish people are unwelcomed almost in all countries as tourists. As you probably know, they haven't done any lockdown. They did not too much tests. And you can see in the statistics, new cases, very few, actually 0, and new deaths 0. Even so, because of their strategy, they are banned to travel. And last but not least, I was told for Israel that this figure which is shown here is too low. And this is the warning of this statistic. Although the statistic gives you a picture, it seems that not everything is reported, A, and B, due to the different quality and number of tests, you have to be a bit careful to draw a conclusion. But on average, it's probably fair to say that in Asia, emerging Asia, in particular Japan, and in Europe, the situation is under control, and most likely there won't be a lockdown, only a lockdown in small areas. In the US, very similar. There is in some states a lockdown, but there won't be a lockdown for the country. There is an election, and they keep on going. Most likely, the figures will go up regarding new cases. Unfortunately, also the number of deaf people, but they will definitely not close down, and you can expect that the US in Q3, Q4, although this illness won't have a cure until then, will have a slightly better growth than we have now. And also this is confirming us that there will be a U-shape recovery, and the key point here is recovery. If it's a U, a V, or whatever letter you want to use is not so important. The key point is, if the future is better than today, markets are going to discount that. And normally the discounting mechanism is between 12 and 24 months. So if you agree with the view of Morgan Stanley that the G20 countries will be back on levels at pre-crisis in Q4 next year, it's perfectly explained why certain assets have risen. There is another reason which keeps us positive. You see on the left-hand side the fiscal stimulus in 3 key areas. Although China started it, and China did stimulate in the past a lot, you see compared to the US and the UK, in percentage of GDP, their stimulus is roughly half. But the amazing information is the Eurozone. For the first time, the European Union is considering a rescue fund, which is financed through debts of the European Union. So far, it seems it will be a one-off, but obviously nobody knows the future. But the important bit is 750 billion, and then we are above 12% of GDP. This is the right medicine for at least stimulating the economy, while on the right-hand side, you see the various QE, PEP, TLTRO programs of the European Union. The good news is they are catching up with America. They are almost at that level. I personally said several times the last two steps in the Fed and in the ECB were a bit too fast and probably not the right medicine. The Fed at least would argue we have done that to make the markets function again. And to be fair, Boeing, as an example, was able to raise money. Ford, as another example, was able to raise money through the bond market and didn't have to use the Fed facilities. Therefore, yes, they achieved the goal, but maybe because of that stimulus, we have seen a too strong move up in risky asset in a too short period of time. Although I was positive and I'm still not negative, but I would argue there was done too much from the central bank side. Having said that, the flip side obviously is this. We will see huge deficits, and the worrisome is Italy and Spain, which already have a debt to GDP ratio above 100. They will add this year more than 12% and next year another 8 to 10% of budget deficit. Also France, which has also a high debt to GDP ratio, is going into that area. Germany, not shown here, is probably in the range of the Eurozone, around 10%, but Germany still has a debt to GDP ratio of 60%. So in Germany, at least, we could argue that they have the possibility to spend so much money, while southern countries are definitely at the edge to have too much debt. And that brings us, obviously, how can you solve that midterm? And the answer is you keep rates at a level which is too low for a very long time period. The Fed even announced it, at least till 2022. And you try to create inflation. These are actually two key ingredients for financial repression. So keeping controlled rates, government bond debt rates below 1%, this was from 42 till 1980, of 2/3 of the time, to finance away the debt to GDP ratio in the US and the UK. This was done there, and you see the US ended up with 120% debt to GDP, and in the UK it went down from above 200 to 138. If you look today, the shadow rate, short rate, which is a kind of measure how effective unconventional measurements work, stands for the US roughly at -1%. So we can argue, although the official rate is 0, with all the measurements, we are rather at -1, and the US still has a little bit of inflation. So in real terms, you definitely lose money in the short term and in the secure assets in the United States. So having said that, we have to obviously to compare the two periods. So you see on the left-hand side, the Great Depression in the 30s, and afterwards the World War II, the government spending was tremendous, and then what followed? That was the financial repression period till the 80s. And more important is you see the global financial crisis. We have seen a tremendous rise, but compared to what is happening at the moment, the government spending in percentage of GDP is just tremendous. And you see that also on the right-hand side, on the fiscal side is one end, but the other side is what the Fed is doing, and the balance sheet is skyrocketing. This already looking scary. Look at this. You see here from QE1, QE2, QE3, they took quite a long time in terms of months. And look at the actual one. It's almost not to see, but starting from March 11, we have now already spent more than QE3 and there is more in the pipeline, and there is no ending until they will stop it. So this is really unprecedented in history, and that is a very good support, at least for corporate bonds, but also for other real assets and also for financial assets like stocks. Oops, sorry, that was one too much. So revisiting what we have written at Rothschild in 2012, and I repeat 2012, we said at that time, and I keep repeating that since then, sometimes more pronounced, sometimes a bit less, but at the moment I'm definitely a bit more pronouncing this fact, which supports my positive view on one hand, but which also explains why so far it has worked. So where interest rates are kept artificially depressed, I mean, definitely that's what central banks do globally. Where central banks directly buying government bonds, well, actually we have passed that already. At the moment, most banks even buy corporate bonds. The Fed even buys fallen angels, which is nothing else than high-yielding bonds. And on top of it, the Fed even buys high-yielding bonds through ETFs. Definitely these two ingredients are here. It best works when one tries to create inflation. Yes, one tries it. So far, there is no inflation and we are in a disinflation environment. To make real interest rate negative, I've just said that's the case. Even traditionally measured, the Fed rate is at 0 and the inflation is very tiny, but there is a little bit of inflation. So you are below 0, and if you use the short-term shadow rate, we are definitely more minus. And then the point is that one tries to tax away wealth from the private sector to the public sector. This is exactly what's going on. Therefore, one conclusion, and we come back in the end to it, if you want to protect your assets, you have to invest in what we call real assets. And real assets for us are different from CFA textbooks: corporate bonds, equities, and gold, and all other assets like direct real estate, watches, cars, etc. What is missing is inflation, but we have already 3 institutions, JP Morgan, Morgan Stanley, and BlackRock, which are predicting that next year we are going to see in the US a pickup in inflation, and they expect that the plateau will be higher than in the past. This would be a perfect situation for the Fed, because then they have achieved what they really wanted, keeping rates low and having a modest inflation, no strong acceleration. This is obviously controversial. It has to be seen if it's possible to achieve that. But if there is inflation down the road, it will be first most likely in the United States from the developed countries. Therefore, gold keeps to be an asset. We are on a multi-year high. Most gold bulls expect that gold will soon reach 1,800 an ounce. This in the light of yield curve control, this in the light of negative shadow short rates, and that the Fed keeps rate at 0 is quite likely. On top of it, I would like to stress that I don't think that the Fed will do what we have in Europe, negative rates. I don't think the Fed is going to do that. They are rather going the way of yield curve control. But then you have definitely a managed market, and risky assets are more than protected because the Fed buys them and controls even the yield. One argument why gold might still go up is simply the allocation of it. Total assets in gold ETFs versus total assets in equity ETFs. You see that the allocation is below 1%, and during 2003 up till the financial crisis, and afterwards it definitely went much higher. Therefore, even from that angle, there is room. So at the moment, the key question is, do we hold or do we not hold? I was personally a little bit surprised that the S&P made it above 3,000. We are now above its resistance level in a new trading range. And so far, as you can see, every time in the last 30 days, we have come down. So far, the market turned positive once reaching one of the moving averages. The explanation is algorithm trading. So every time hedge funds have made some money on their shorts, they unwind them and they buy the dip. And that's at the moment the strategy. The positive news is we see since 30 days a consolidation. But actually it would have been healthy to see a correction, which so far hasn't happened. Overall, I would argue that stocks are well supported and buy the dip most likely will work out. The open point is if at the moment we are at levels which are dip or if we see lower prices. And this really depends on short-term news. Last time we were down, the Fed just announced, well, actually, we are going to buy now direct bonds, and immediately the market turned in the Dow Jones from minus 800 points to plus 200. Tremendous intraday rally. The future will tell, but I definitely would not under-allocate to equities. Here you see the same. The orange line shows you the move of the S&P over the last months, and you see this rise was so strong, so fast, that a consolidation is the minimum which would be normal, or even a correction. But on the other hand, with so much money floating around, you really cannot rule out that we just continue going up. Spreads and corporate bonds. I have deliberately shown you here two tables. One shows where the spreads were when we last had this seminar in a larger round, and where we are now. You can see that after the sell-off, spreads have come down almost 70% of what they have risen, and that the performance of the bonds was tremendous. Now we are in a consolidation phase, like the equities. You see the spread have come up and bonds slightly down. Interesting for me is the comment underneath. So the Fed even keeps supporting qualities companies like AT&T, United Health, or Walmart. This under the umbrella of their emergency lending program. This is also something which gets forgotten, but the Fed also at the moment gives credit to companies. Not only they buy bonds, but indirectly they also finance them through credits. Therefore, bonds are well supported. We still prefer BB. Fallen angels is a good area, but also companies which were BB before, for us, is a very interesting place. The Fed goal is to keep corporate bond market working, and you can see that we have seen a lot of new issue year to date, and the forecast is that we are at least matching it what has been done last year, which was a good year for new issuance. So to be fair to the Fed, we have to agree that at least this goal was achieved. Companies like before, several times mentioned, Boeing or Ford were able to refinance directly through bonds and didn't have to use the credit facility through the Fed. So therefore, yes, it worked with the price of rising asset prices. The key question, which obviously nobody definitely can answer, is have they risen too much or are they fair valued? We would say they are expensive, but we would definitely not bet against them. Unfortunately, where there is light, there is also shadow. Zombification, zombie companies, so companies which have a business which produce revenues, but the revenue is not enough to finance their debt burden. So basically they are loss making and they keep piling up new debts. but the debts at a too low level and they are kept artificially alive. Deutsche Bank estimates that roughly 20% of all US companies are in that area. So that's the flip side of this program. You can turn it around if you are invested in single B companies, even if they might be expensive, even if they might be loss-making, they probably will survive for quite a while given the rate outlook. That also means that to invest in so-called risky bonds is less risky than it should be. The yield has lost its function to give you an indication of how risky certain investments are. Over the last 2-3 days, when markets were volatile, we have seen a little strengthening of the dollar, here shown as the DXY index. However, since May, dollar lost ground against most currencies globally. This is actually good news for the growth outlook of emerging markets. And this also confirms us that besides fallen angels in the US, corporate bonds on selective companies in emerging markets are worthwhile. So with that, I come to the conclusion. On one hand, I wrote, wait until the dust settles. This was written on Friday, and Friday was a tremendous sell-off. I don't know if we are at the bottom in the S&P or if we rebound from here, but definitely don't under-allocate to US equities and to equities in general. Having said that, spreads and corporate bonds are still offering better values, good values. We prefer US high yields in the double B areas, and we concentrate on emerging market corporate bonds. What is key is please double check the balance sheet. See if the debt compared to the equity and the debt burden and is in a way that with the revenues it can be kept or not. So don't buy zombies. It is difficult to see always zombies, as Wirecard teaches us a lesson over the last couple of days, because the balance sheet looked pretty okay. However, if 25% of the balance sheet is fake, not existing, then it is a bit tricky to do your homework. Gold, I believe gold has at the moment a place in the portfolio as an insurance. If you are a risk taker, gold miners trade at price to book of 1, most of them smaller ones even below 1. So they are offering, at least from this measurement, a good entrance point. Real assets, and I said before, real assets for me in terms of the financial repression scenario are as well shares of companies, because I consider a company a real asset. We can discuss that because it's a financial asset on something real. Also, corporate bonds are for some people real assets. The wording is one thing, but we believe these two areas are interesting. Gold is definitely a real asset. If you have access to, and if you are keen to, I have seen recently an auction of watches. It's amazing what an old watch from the owner of the manufacturing got sold off, because it is considered a real asset which keeps its value. Art, very similar, old-timers, and there are much more things in that area. But there you really need to be a fiend, you need to have access to good information and sources. But it is more than likely that these assets will keep value over the time. And this is important because all this money which is printed will down the road probably create A, bubbles, B, a burst of bubbles, and last but not least, at a certain type of inflation. Having said all this, we don't believe that the assets, especially liquid ones, are cheap. By the contrary, they are supported by tremendous stimulus. As we speak, already for almost 2 months, there is a 5th stimulus package in the US Parliament pending. They hold it back because of the reacceleration of Corona, but it is quite likely that probably even before the election there will be a 5th US stimulus package. The Fed keeps firing. They said they will keep buying bonds for an undisclosed time period, so as long as they think it's needed. This all obviously has the risk of melt up of financial assets, but is another reason to buy definitely financial assets. Last but not least, if the last institutional are right and we see a slight rise in inflation in the US, it makes definitely sense to buy US stocks and certain corporate bonds. And I know that this is a very simple advice, and it's so simple that I'm almost ashamed to say it, but it has served well so far. And if Mr. Powell or Mr. Buffett can say it, I think I can repeat it. Don't fight against the US economy. Normally they say the Fed, but at the moment I think it's fair to stress economy, because on top of everything the Fed did over the last 12 years, we have now as well the fiscal stimulus. With that, I thank you all for listening, and I'm opening it up for questions.
You managed to cover nearly all aspects of current situation. So let's move to a question, and we have some question in our chat area. So, well, the first question was about Taiwan category bonds. Can you comment something on that? What should investors take into account when investing in this class of assets?
Did I hear well? Taiwan corporate bonds?
Yeah.
Whew. I mean, we rather would look at company names and not from an area. We have a lot of Chinese bonds. I'm not aware of any particular bonds in Taiwan. I know that there are a lot of chip makers and other suppliers. The key risk in Taiwan, and I also think there are
Andreas, sorry, probably I did not spell it right. Taiwan, which means a kind of subordinated bonds, Taiwan category.
So you mean unsecured subordinated bonds?
Honestly, I'm not that great expert to clarify which is meant under Taiwan bond, but I suppose there's something in a kind of special instrument issued by banks.
Ah, okay, but then we are more in the area of COCOs.
Yeah.
And perpetuals. I mean, they offer interesting yields. They have a fluctuation of equity. Basically, it depends case on case. You can make a lot of money with it, but you have really to understand the bank or the company behind. And in the worst case, you have to know the details. Are you converted to equity, or are you just losing all your money? Because there are two types of payments, and I would rather prefer to get equities than to be wiped out. But if you have this under control, they can be very interesting.
Okay, second question is, you mentioned actually in your presentation that you expect rising inflation in US, and actually I think if we see high inflation in US, we will see high inflation all over the world. But the question is there a risk of a really sharp increase in such an inflation? So is 15% or more inflation in the US something positive, or something possible, or it's absolutely impossible?
Well, nothing is absolutely impossible, but it's a very smart question, actually. I mean, I would say that if inflation is going to rise in the way I described it, it's an expected rise. It's a, in bracket, contained rise, and that's in midterm rather positive. If it would be unexpected, a sharp rise to 15%, obviously this would be extremely negative. At the moment, and I must stress at the moment, I don't see any indication that that might happen because we are still in disinflation environment. It all will depend once it starts rising, once the economy starts to grow again, how you pull out money, do you sterilize certain money injection? And if the answer is yes, like in 2009, 10, 12, 11, like the Fed did, then there is no risk. But honestly, nobody can know that. But the short answer is, at the moment, I don't see that.
Okay, very logical question. I would say that following Brexit, what is your view on the UK and British pound in short run and mid-term and long term?
Well, first of all, most likely there will be a Brexit without a contract, because all these negotiations which were done now during the Corona crisis, the communication was in a way that the two positions are too far away from each other. So short term, the pound is under pressure and volatile. Mid-term, obviously depending how they will structure next year the world, how they will solve the possible turbulences. Mid-term, I think a country like the UK, although much smaller than the US, but they have then the freedom to do trade globally. They have the currency as their weapon. So mid-term, I'm rather positive on the outlook, more than on the Eurozone, because the Eurozone has a currency which is, for some countries, too strong, Italy, Greece, etc. And for some countries too weak, like Germany, they profit a lot from it. And there is no solidarity. So the North doesn't want to pay for the South, and the South cannot use the devaluation of the currency, and there are structural reform missing, etc., etc. So I'm not very positive on Europe as a whole, but if I have to bet on the midterm future, I would bet on the UK.
Very interesting. A question which is probably not related to investment ideas, more kind of geopolitical question. What is your view on the Hong Kong future situation after China government restriction? So what will be, what is your opinion? What will be with Hong Kong as a financial and investment hub?
I have seen some investors and banks contemplating to move from Hong Kong to Singapore or Macau, but I haven't really seen moves. Definitely, China is doing everything that before, I think it was 2044, that they get control of it, and that this situation, one country, two systems, is unfortunately going to end. I obviously cannot know the future, but I think the Chinese are business smart, and therefore I'm still very hesitant to foresee that they will deliberately destroy the financial hub Hong Kong, although they will get more control over it. But really nobody knows the future. What I can tell you is that at least the contact we have to Hong Kong, and we book there, and we work with banks, it works all smoothly, disregarding all the pictures you have seen on TV. But it's definitely a movement which is worrisome, and which is actually against the contract they did with the Brits.
So investment bankers in Hong Kong are not packing their thinks to fly to Singapore or somewhere else. Good. Okay. One more question, which is I don't believe there is actually an answer. Do you know if there are any unified conditions discussed or agreed on the triggers for the lockdowns? So I don't know if it's about agreement or what.
I would say this is country dependent.
Absolutely.
And I mean, I know quite well Switzerland. I know a bit about America. I know very little compared to you guys about Russia. But even in Russia, is a good example. If I'm not completely mistaken, in all these countries I mentioned, there are more. At the beginning, it was centralized, and now it's decentralized. So whatever local government has now the authority to do lockdowns, for instance, of bars, of discos, or of whatever is needed, also in Germany, actually. And the political will, at least for the countries I plus minus have in mind, is not that there will be a second countrywide lockdown. Where the decision is made is open, but for instance, Texas, I know pretty well because we have a connection to the Texas University. It's really complete lockdown. Everything is closed. People are at home and the shopping is almost impossible to do. But this was decided locally. And if there is any answer to that very difficult question, I would argue that future lockdowns will be decided more locally than central, and they will be more temporary and probably selective. I mean, in Switzerland, we are discussing, for instance, in the city of Zurich, and not in Switzerland, to close down bars because we had a super spreader event. If that will happen, it's still open, but our government, and obviously we are a bit a decentralized country, but they even said, we had our central decision process, this is over, now it's really on you guys local. And this I see definitely in the US. I think in Brazil it's very similar. Some of the local government disobey what Mr. Bolsonaro is saying. But there is no uniform answer. It really depends country by country, region by region. Or give you a stupid example. If you fly to Lisbon, the city of Lisbon is all free. 17 communities around Lisbon. You don't really feel outside of Lisbon, but they are locked down starting tomorrow, decided by the local governments.
Yeah, absolutely. I totally agree with you, and it's exactly what we see, for example, in Russia, that it is more and more and more decentralized, with regional authorities taking their own decision, and it's everywhere in the world. So it's a global trend not to have such unified triggers and criteria. One more question. You mentioned don't find the US economy. What is a fair valuation of S&P 500, and on what valuation basis? Actually, it looks like you touched it in your presentation, but please comment once more.
I would have a slide in my pack. But first of all, I would argue a forward-looking P of the S&P above 25, it is expensive. But the question is rather twofold. How far can it go? And how realistic is this 25? Because this 25 is basically derived from a massive recession in earnings. And I'm almost sure that the earnings are higher than what is actually in the estimates. So I don't know where the P is at the moment, but I would rather argue we are closer to 20 than 25. This is expensive, but if you look at Chile P around 27, last time dot-com bubble, it went to 45. So I would argue that we will see the high levels, the all-time highs actually from February this year again. But I would never argue that the valuation is justified by any measures. Price to book is high, P is high, Schiller P is high. But at the moment there is TINA or FOMO, so fear of missing out, or there is no alternative. a smart guy from GMO said he expects a final melt-up in the next 2 years. 2 years was this February. To be fair to this guy, we were at all-time high. In the meantime, we had Corona, but as you know, we continue to going up. And I would rather bet on the upside than on the downside. But nothing is cheap. It is really expensive. And also, since probably 2012, the US is the most expensive market in the world, but it keeps going up. So far, we have seen earnings picking up, but at the moment, that's the key open question. The only thing I think is probably for sure next year's estimates at the moment from analysts, be it bottom up or be it top down from strategists and from guys who do GDP forecasts, is most likely too pessimistic.
By the way, from my side, for US as a country, as economy, do you think that this last protests, even riots in some cities, is something serious that can really damage the economy, or it's a kind of political struggle between Trump and the Democrats, and this will not result in any damage to the economy?
I mean, there are historical analyses were done, and the analysis were when there was Korea, Vietnam, etc. There were also riots. There were also riots in the 60s with the Blacks, Ku Klux Klan, etc., etc. I'm not the expert. However, the conclusion that all these events they were politically relevant. They might get a new president or something else, but in terms of stock exchange development and economy, the impact on the stock exchange was close to zero. The stock exchange even went up. And the impact on the real economy was extremely limited. Because even if you see 1 million of people in New York or wherever, look how big the country is, how many people live there, and how many people work there. And even these demonstrants, people, most of them work on, maybe not on that day, obviously, but on average they work. So if history is any guide, I would say it has political impact, but the impact on the economy is tiny to neglectable.
I see. Okay, and probably the last question that we have for now is what do you think about sovereign bonds performance on emerging markets like Costa Rica and Mexico?
Costa Rica, I have no clue, to be honest. That's the straight answer. Mexico, we own Mexican companies which are quasi-state owned. I don't know what the Mexican government bond did, but on average, I would say Mexico will probably go well through the crisis. It is really hard because I would have to have now the Bloomberg. I mean, the honest answer is Mexican corporates, yes. Sovereign bonds, I don't know.
Okay, so thank you very much. Actually, you can check bonds not only with Bloomberg, but with Cbonds as well.
Definitely.
Well, actually, for many, many private investors all over the world, Cbonds is a right choice as a data platform to see their own investment decision, to make their investment decision, to check the performance of their portfolio. So I will now ask Masha to make not a presentation, but to put a slide with a short description of what is Cbonds and what we do. So we provide a full coverage of all bonds in the world. So you hardly can find any bonds that is not on our web platform, and you see the performance of bond, valuation, prospectus, and we have the best coverage of prospectus for bonds. You have very profound opportunities to search bond, to compare bond, to put them in watch lists, etc., etc., etc. So everything you need for making bond investment decision. You will find it on Cbonds, but also we are not limited to bonds only. We have equities, we have a huge amount of indices, macro indices, bond indices, stock indices, etc., and we are constantly growing. We are improving our coverage. So if you are interested in Cbonds as a data platform for your investment decision, please call us. We will provide you a free access for a couple of weeks, so you will see what we do. And yeah, actually hundreds of investors in all over the world are now our subscribers. So thank you very much, Andreas. Thank you, and Blackfort Capital as our partner for today's seminar. It was really very interesting, and thank you for your really profound expertise in all asset classes. Thank you very much, and stay with us for our new event in the future. Thank you.
Thanks a lot for having me.